Private entities measure success through a standard corporate equation: revenue minus expenses equals profit. But for a government, the objective is service delivery. Measuring this outcome requires discarding the private sector blueprint and building an entirely new accounting architecture from the ground up. You cannot evaluate the fiscal performance of a sovereign state or a public agency using private sector metrics like return on equity. Public entities do not exist to generate a financial surplus for shareholders. They exist to execute public services and redistribute wealth across a population. Because the ultimate objective is different, the traditional accounting frameworks used by Wall Street are ineffective for measuring government performance. We are going to construct the International Public Sector Accounting Standards, or IPSAS, conceptual framework from first principles, mapping the rules of financial reporting directly to the realities of public administration. Forcing corporate financial reporting onto a sovereign state forces the entity to optimize for cash flow instead of public welfare. It obscures true accountability by measuring the wrong outcomes. Any financial reporting framework must begin by identifying who will actually consume the data. Standard corporate accounting prioritizes investors and creditors who are looking for a return on their capital. The public sector serves a different audience. The base layer of the IPSAS framework identifies the primary users of general-purpose financial reports. They fall into two groups. Service recipients are citizens who rely on the state for infrastructure and welfare. Resource providers are taxpayers and lenders who supply operating capital. These users have two core objectives when reading financial reports. The first is accountability. Governments exact massive amounts of resources, often involuntarily through taxation. The public requires a mechanism to force the state to justify how those entrusted resources were managed. The second objective is decision-making. Users need accurate data to inform their voting preferences and determine future resource allocations. Unlike private equity firms or major creditors, everyday citizens lack the authority to demand custom financial data from a government agency. The GPFR is their only standardized tool for oversight. A public sector GPFR is not designed to help an analyst seek alpha. It is designed to help citizens demand justification for the power and capital entrusted to the state. This schematic introduces three structural constraints unique to the public sector: non-exchange transactions, budget primacy, and sovereign longevity. Sitting on top of the user base, we examine the first pillar, showing incoming capital completely decoupled from the outbound stream of services. Citizens pay taxes, but they do not receive proportionally equal direct services in return. A taxpayer does not buy a specific unit of national defense. This breaks the standard corporate cycle of direct exchange. Because of this asymmetry, the accounting framework must prove how pooled resources were deployed efficiently across the aggregate population, rather than tracking individual transactions. The second structural constraint to consider is budget primacy. In corporate finance, a budget is an internal forecast. In the public sector, the approved budget is a binding legal mandate authorized by the legislature. Because these budgets carry the force of law, unauthorized spending constitutes a breach of constitutional authority. Mapping actual results against these limits is the primary method for demonstrating legal compliance. Finally, we reached the third constraint of sovereign longevity. Specialized public assets operate on a timescale that outlives normal corporate lifespans, weathering decades of physical and political seasons. Governments hold assets like highway systems, national parks, and military installations purely for their service potential, spending, ensuring the executive branch obeyed the law. Next, we examine the service achievement zone. A government can show a balanced ledger while simultaneously failing to educate students or pave roads. Qualitative, non-financial data regarding the actual delivery of services is required to prove that the public received what they paid for. Finally, we look at the prospective info zone. A balance sheet only captures a single point in time. For a massive sovereign entity managing multi-generational commitments, the present day is only a small fraction of the story. The GPFR requires forward-looking modeling to assess long-term solvency. It maps anticipated demographic shifts against future service demands to determine if current tax rates can sustain future liabilities. A standard corporate 10K is primarily focused on historical results and current position. The public sector GPFR is a comprehensive, forward-looking diagnostic of a state's capacity to survive and serve its populace. Expanding the scope of financial reporting to include non-financial data and future projections introduces a critical risk. How do you prevent political manipulation? The qualitative characteristics act as a strict filtering lens over the framework, constraining what information enters the GPFR. Relevance requires data to have confirmatory or predictive value. Faithful representation demands reporting depicts economic substance over legal form, ensuring data is neutral, complete, and error-free. This relies heavily on the concept of prudence. When modeling sovereign uncertainty, accountants must exercise strict caution to ensure assets and revenues are never overstated, and liabilities are never hidden. These qualitative filters act as the ultimate safeguard. They prevent governments from using subjective, long-term projections to mask underlying fiscal deterioration. This is the completed schematic of the IPSAS conceptual framework. Resources are extracted involuntarily from the base layer, routed upward through strict legal constraints, and output into an expanded reporting scope that satisfies the demand for accountability. IPSAS acknowledges the reality of the state. It accepts that public finance is inherently political, bound by legal budgets, and built entirely on non-exchange models. By codifying the movement of capital within these public sector constraints, IPSAS creates a structural mechanism for holding governments accountable for public well-being over generational timelines.